Mr. James Wadi is the group economist at BancABC, which is part of Atlas Mara, which is it has got operations in 6 regional countries. James provides intellectual leadership relating to all aspects of economic research, business and strategic related issues in Botswana, in Mozambique, Tanzania, Zambia, Zimbabwe, Rwanda, Rwanda being the latest addition to the group of BancABC. He has been involved in the bank's transformational journey, which has seen the bank changing from a purely merchant banking model to a fully fledged commercial banking outfit. I see that he's quite a clever chap. He holds a MSc in mathematical modeling from UZ. His first degree was in BSc Maths, which also at UZ. He was awarded the British Chevening Scholarship in 2004 and proceeded to study MSc in econometrics at the University of Manchester in the UK, which he completed in 2005. Then he also did a management leadership course in GABS, which is a university in South Africa. He's a widely experienced economist, and he also worked for a Reserve Bank of Zimbabwe prior to joining BancABC. He is also an economic and banking committee member of the Confederation of Zimbabwe Industries, CZI, which is a representative body of various industries that advances the interest of the business by engaging with government and Reserve Bank and other stakeholders. Ladies and gentlemen, Mr. James Wadi.
Good morning. Thank you for your kind remarks. My task is an easy one because I'm about to talk about the economy, and given what Zimbabwe has gone through over the years, one thing that I've learned is that because of the material impact the economy has had on our pockets, it has taught everybody to be an economist in one way or another. So, be that as it may, I think it makes my task very much easier because we are almost like talking to the same group of guys who understand how money exchange rate works. One of the things that I noticed is that even our grandmothers in the rural areas at some point in time when the Zim dollar was very fluid and losing value, they could understand that it's a currency that you have to run away from quickly. The moment you get hold of it, it means you want to quickly buy or possibly change into some kind of store of value. So this store of value could be a goat, it could be rands. So you can see it makes it easier because when you talk of exchange rate, they will quickly remember to say when the currency is losing value, you want to run for cover. So, from that perspective, it makes our work easier because we end up talking on the same language. Be that as it may, my simple presentation is touches on the global perspective as well as what is happening on the domestic economy. And from a domestic economic perspective, we'll talk about the current economic update, as well as what is happening, or what is our expectations going forward, where this optimism is arising from the new dispensation. Straight into it, when you look at what is happening in the global economy, I think one of the things that we're happy about is the global recovery seems to be taking place. And one of the things that we missed in the past is that, remember, there was a boom some time ago when the global economy was doing extremely well. But at that point in time, our domestic policies were such that they made us fail to catch the boom. To the extent that even when the global economy was doing well, we could not ride that crest. simply because of the domestic policies that we were pursuing during that time, which prohibited us to enjoy the benefits of the global economy. So this change in economic environment is exciting for us, because what it means is, as the global economy is recovering and our environment, we are putting our house in order, we are very hopeful that possibly we'll be able to catch that crest as the economy improves. And with sub-Saharan Africa, again, what is clear is that because the economy moves in cyclical, sometimes there's a boom, sometimes there's a contraction. And what is happening presently is that, yes, we are on the recovery path in the region or in the global, but that recovery path is still way below the level that we witnessed in the past. So what it means is we still anticipate that the recovery should continue to grow. Be that as it may, I think the issues to do with the trade tension between the US and the rest of the world is a major concern, because we have seen some dramatic policy shift from the US. And that is a major concern in the sense that it can have a possibility of even igniting the tit-for-tat tariff wars. And that has potential to reverse the global momentum that we are talking about. The previous speaker spoke about trade, and trade being the facilitator for growth. And the trade war, it becomes a cause of concern, because what it means is countries can go into protection mode. And when they go into protection mode, it means the free flow of goods between nations and between economies is not able to take place freely. And it becomes a cost to business. So that is the danger from the world perspective that we are facing. Africa, in perspective to the global economy, is still very small. So in this case, what I've put there is, these are the sizes of the economies. And sub-Saharan Africa, which I've put there, the size of this bubble represents the size of the economies. So when we speak of Africa in the context of the global economy, you can see that our size is very small. In fact, we are more like innocent bystanders. Whenever these wars are happening, they're happening with the big guys. But the ripple effect often affects us, despite us being sometimes participant of those challenges that will be taking place. But in this case, it gives us the global perspective to say, in the global waters, what is our size relative to the others? And I've just tried to choose specific global economies. Like, for example, when you look at the US is the largest economy in the world. It's a $19 trillion economy. That's what it means, right? Look at China. China is your second largest economy. It's roughly a $12 trillion economy. Now, the Euro area, your Germans, the UK, and so on, as a region, it's about a $12.5 trillion economy. Africa, this is sub-Saharan Africa, roughly constituting about maybe 45 countries, because it excludes your Middle East, like Northern African, like your Egypt, your Tunisia. So these are the sub-Saharan Africa, roughly about 45 countries. It's a $1.2 trillion economy. So you can see that relative to the global, we are very small. Be that as it may, the growth potential for Africa is quite encouraging, because of our smallness. I think the growth is still huge in Africa. That's why sometimes the world will look at Africa and look at the prospects for growth in Africa. So that makes the region quite exciting. And the region or the continent is endowed with vast mineral resources. And most of these big countries, they don't have those resources. So for them to grow and support these large economies, they need the raw materials, and Africa provides those raw materials. But I think as Africa, we need to move beyond just providing raw materials. I think people have spoken about how to enhance the raw materials, beneficiation and so on and so on, because that's where the game is. I think as Africa as a whole, that's where we need to move away from providing raw materials to the big guys and try to provide sort of a much more beneficiated. That would, I think, change the spectrum of our size in Africa. Having done that, I will go to the domestic economy. Basically, the domestic economy, I will touch on what has happened in the recent past. And what has happened in the recent past, you can see around the November, the change of political leadership brought in some kind of change in policy shift. And before doing anything, I think that change in policy shift resulted in some kind of improvement in investor sentiments. So in some instances, what it means is some of our problems were so much that you find out possibly you solve the bulk of your problems by the changing the policy direction before you start doing anything. So I think that's what happened in November. Around December, March, the adoption of the business-friendly policies began to resonate with the investors. And the relaxation of the indigenization law, the issues to address the land, the international engagement, and some various MOUs that were signed and deals that were signed in various sectors, I think they helped to improve the sentiments. I must hasten to say some of these deals, in as much as there's so much hype, I think in some instances they may take time to come to fruition. That's my perspective. But be that as it may, around before June, we have already seen that investor sentiments translating, even from the likes of the IMF. We have had to revise the Zimbabwe's GDP. In fact, their anticipation was that possibly the economy would grow by 0.8% initially. But they have had to revise that GDP to about 2.4% in 2018, which is resonating with the positive sentiments and the things that government has been talking about. Although I think much is awaited in terms of some of the, walking the talk in terms of the implementation of some of the things. But I think that good intention and the political will has been well received by the, investing community. The general elections, we think, as they have been announced about on the 30th of July, post the general election, we anticipate some kind of post-election recovery associated with sort of some economy-wide reforms, because normally even from a world over, when the country is faced with some watershed elections, we are quite cognizant of the fact that government may not commit to certain policies that would transform the economy. So that we are aware. But we take hope that from the positive sentiments and the political will that has been displayed, we think that political will enable us to possibly pursue the economy-wide reforms that we need. And possibly part of it would be maybe even clearing the arrears with the international community. So I think that would set the pace to economic recovery going forward. There are things that I will speak about when you go forward. But be that as it may, there are certain issues that we are faced with at the present moment. For instance, the issue to do with the inflation. We think presently, when the reported inflation at roughly about 2.7%, there is a general feeling that possibly the real fuel inflation, what you feel in the pocket, is not commensurate with the official reported inflation. I think so. Sometimes there seems to be a disconnect between what is reported as the official inflation and what, as individuals, we are feeling in the pocket. So that is the general feeling. But this inflation, it comes at a point when the economy had witnessed 28 months of sub-zero inflation. This is a time when inflation was in negative territory, where margins were very depressed and inflation was in the negative territory. And since then, we have seen inflation rising quite phenomenally. And one of the major drivers of this inflation has been associated with the foreign currency shortages and the activities in the parallel market. So because significantly more businesses are not able to access foreign currency in the formal channels. We have had a lot of businesses relying on the parallel market, and because the parallel market, there are higher rates, that price is being passed on to the consumers. But what is coming out as well is that the high prices that we are facing, sometimes they not good for the economy, in the sense that consumers were forced to look for substitute in the form of imports. So you find out in the end, you end up having pressure to go and look for foreign currency and import rather than buy locally. And that is not a good phenomenon. And that is one of the things that as an economy, we are facing the threat of inflation, eroding the disposable income, and again, people looking for foreign currency to buy imported goods, which are deemed cheaper than the local produced goods. On the exchange rate, I think what we have witnessed again is the three-tier pricing system, where possibly prices can be priced in actual US dollars, in bonds, and in RTGS. And with RTGS attracting the highest premium. In most cases, it's just a reflection of what is happening on the parallel market. I will not dwell much about that. But let me move on to one of the critical areas that I think has a significant bearing in terms of the economy, is the performance of our government in terms of the fiscal. Because what it means is, because government is a major player in this economy, if government has significant economic imbalance in terms of how it's managing its fiscal, it can easily cascade, or it has negative knock-on effect on the economy. And that could be a major challenge that we are facing. What is the current scenario? How is government spending its money? In most cases, in broad terms, government is spending its money through employment costs and other, current cost. Then it's paying interest on debt. They are paying interest on debt because they've acquired. So they end up paying interest on debt. They have acquired debt. They end up paying interest on debt. And there's a small portion on capital, which is, investment in infrastructure. Ideally, we would want this capital spending to be a bigger component, because that would talk about the investment that we are putting in terms of the infrastructure that will make, improve the efficiencies and reduce the cost of doing business. So presently, government is in a scenario where most of its money is recurrent. In other words, about 85% is recurrent, meaning we are consuming. This is money. And we are not leaving enough for investment. So that is the scenario that we are facing. And how does this arise? I think some of the things are quite clear. On the right graph, what I've put here is I've compared the revenue government is getting vis-a-vis the wages or employment costs that they are facing. So this graph says in 2009-2010, out of every $100 government is collecting, $60 was going to wages. So, in other words, under normal circumstances, you want to say if you collect revenue, if a lower portion of that revenue is going to wages, it means the balance, you can leave the balance to do other things like your investment, and which is good for the economy. But what has happened over the years, it means that over the years, our revenue, in other words, the wages that you've been paying for every $100 has been increasing. So we are increasingly leaving small portion for investment. This is the conundrum that we are facing as a government. So in 2010, what it means is for every $100 government was collecting, $64 was going to pay wages. But come 2016, 2017, for every $100 that we are now collecting, $90 of that is going to wages. So that is a problem, right? Because it means you're only left with $10 to do other things like there's other expenditures like, there are other operational expenditures that you need. You need to use the other $10 to pay interest, the other one to pay as a capital. So increasingly, there is not much money that is left for the other critical areas of the government. So as a result, how does government compensate for that shortfall? The government will begin to borrow. So that is the scenario that we are facing. Government begins to borrow, and when it begins to borrow, we incur what is called the budget deficit. So my next slide speaks of the budget deficit. What does it say? It says, for example, in 2015, government had said we are not going to borrow because our revenue will be able to be matched by our expenditures. But at the end, what did the government do? It ended up borrowing and incurring a budget deficit of about 109 million, okay? Which was not a big deficit. Now, in 2016, government said, when we collect our revenue and spend, we plan to incur a budget deficit of 150 million. But what ended up happening is the budget deficit was 1.4 billion. So you can see how our problems are compounded. To say what we have budgeted for and what we end up having, there's a huge mismatch. So in other words, we're budgeting a small budget deficit, but the actual budget deficit is more than 10 times what you have budgeted for. But how do you compensate for that? It means possibly government has to borrow. And because government does not have other options to borrow externally, it means they start to borrow locally. And when you start to borrow locally, what does that mean? It means you begin to compete with business to borrow on the same resources because you are going to the banks and borrow. So that is the conundrum that we find ourselves in. In 2017, government had said they budgeted a deficit of 400 million, but we ended up having a budget deficit of about 2.6 billion, which is huge. 2018, government planned to incur a budget deficit of about 670 million, but we think possibly a 1.5 billion budget deficit is more likely. So there are things that, in as much as we want them to improve, we take cognizance that this year they may not improve from that perspective. There are a lot of reasons, some of them the fiscal pressure coming from an election spending. We have seen civil servants pressure, asking for salary increase, and those things would impact on this budget deficit. Hence, our estimation that possibly a deficit of about 1.5. And some of these things, the problem is we are relying on the domestic sources to fund this. Now, when you are relying on domestic sources, it means the financial resources, some of them which were supposed to go to business, they end up going to government, which may not be good in the long run for the economy. So that is the scenario that we find ourselves. In this case, this speaks to the liquidity challenges that we are facing. What does it say? It says in 2010, 2011, 2012, when you look at our liquid cash as total banks that we were holding, on average, liquid cash, which was made of the nostro accounts and the foreign notes that the banks was holding in their bank coffers. On average, the banks were holding something in excess of 600 million, okay, which was kind of sufficient to take care of our day-to-day transactional needs. But over time, we have had to run down our liquid cash holdings because of the underperformance of the economy that I will highlight going forward. 2014, 2015, the average cash that we are now holding, together with our nostro, about 450. And 2016, 2017, the average has come down. So I think that speaks to the liquidity challenges that we are facing as an economy. You can see that over time, we have gradually run down our liquid cash. As a result, we are no longer able to meet the cash needs of the economy. So this is the scenario that we face as a result. I think there's a slide I had that will speak to that as to why we have run down our nostro, because in some instances, it's a function of how the economy is performing from the export-import perspective. What has been happening in terms of deposits? In 2010, these bars, they represent the deposits. The deposits were growing, so were the loans. So what it means is 2010, 2012, 2011, thereabout, when deposits were growing, banks were increasingly converting those deposits that they have collected into loans. Over time, what has happened? We have seen a scenario where deposits are growing, yet the loans are stagnating, which is not good because ideally you want your business to be borrowing. So if business is borrowing for working capital facilities, they are able to convert those working capital facilities into production and the economy grows. So we are faced with a conundrum where businesses are not borrowing or are afraid to borrow and expand and use production. But on the other hand, we've seen credit to government increasing phenomenally. Why is this credit to government increasing? You can see it's coinciding with the period when government is incurring the huge budget deficit. So this is where I was saying, when you look at government incurring the budget deficit, who is funding those budget deficit? They end up competing for the same resources in the banking sector. So that is a scenario from a government and policy perspective where government has to reverse that scenario. That's why government has been focused to say they need to arrest the fiscal spending. So which is the right message, but there are things that we will need to follow. So that is the scenario that we are facing where the credit to government is growing, the loans to private sector are stagnating, or even sometimes coming down, meaning to say businesses are not borrowing as much. And if they are not borrowing as much, it means their capacity to increase production is significantly reduced. And that borrowing is increasing the money in the economy. And that is not good. So we have a scenario where presently banks are sitting with the, huge deposits, but the borrowers are not coming forward to borrow. So that is a problem. And in some instances, the issue of foreign currency is affecting the borrowing. Why? It's because some of the businesses would want to borrow so that they import the raw materials. But if you are not able to get the foreign currency to import, so it means your borrowing needs are significantly watered down. So that, again, is the impact of the foreign exchange shortages that we are facing. Going forward, again, what is the scenario in terms of this conundrum? As an economy, there are certain dynamics that are there. You have your sources of foreign currency, and how do we keep that foreign currency, and how do we use that foreign currency? This is what it says. It says, what are the sources of foreign currency? We either export, we can get the diaspora remittances. Sometimes we can even borrow externally. These as lines of credit. They can be foreign investment or even grants. So those are the sources of foreign currency. I will show you why sometimes we are in this quagmire. It's because this side has been significantly affected. This is the stock of money. When it comes to the economy, we can keep it as nostrils, we can keep it on the RTGS, we can keep it as cash in the bank, or we can keep it as unbanked cash. This is cash that we are holding in our various houses. So the money comes in the form of exports, in the form of diaspora, even our relatives sending us money, even external loans, investment, and so on and so on. And how are we using it? We either import, pay for services outside, and even leakages, they are there. So this is what has been happening. So the dynamics of these, they will contribute to the liquidity in the market. So generally, that's what it means. So, but going forward, what does it mean? We said the sources of money are exports and diasporas, and we want to say what is the contribution of these exports to the sources of money. In other words, those exports in totality, exports, they roughly contribute about 58% of total foreign exchange that we have. So when we perform well from a business perspective, almost 60% comes as exports. 28%, these are international remittances, those are diaspora remittances. Then external loans, about 8%. Then the other foreign investors and in receipts. So when governments speak about international engagements, when they speak about, making business-friendly environment, issues to do it, improving confidence, the impact would be you are likely to see export, if you turn around our local businesses, export performance should increase, right? Even international remittances, because people become confident and they bring in their money. So what has been happening in the past years, these are international remittances. This is in terms of the quantity, where international remittances are made up of international organizations, your NGOs bringing money, and donors, and as well as diaspora remittances. But over time, you can see international remittances have been coming down. It's a reflection of the lack of confidence in the economy. So when governments start talking about issues to do with improving confidence, improving business environment, it's likely to reverse this downtrend. So when it reverses, it means people are able to bring their money to Zimbabwe, and we are likely to see a reversal of this trend because it constitutes a significant part of our international inflows. In terms of the export performance, this is the export performance. It's represented here to say on a yearly basis, our exports vis-a-vis our imports, because imports are more than our exports, we ended up incurring the trade deficit. So you can see on an annual basis, our trade deficit in excess of 2 billion means, under normal circumstances, you need trade deficit to be as small as possible, even to be a surplus. Because if it becomes a surplus, it means we are able to remain with some kind of reserves. So we are in a situation where our exports are significantly lower than our imports. And the thrust is to make sure that we promote the export performance, and the trade finance that we are talking about, it seeks to address some of these things, where you are saying we need measures that promote our export so that we cut this disparity between our exports and imports, so that when we cut this disparity, it means possibly the liquidity issues are resolved from that perspective. What has been the export basket? The export basket, what do we export? Roughly 26% of our exports is agriculture. Manufacturing, in the past, our manufacturing used to contribute quite big to the export basket. In the past, in fact, our exports from manufacturing were in excess of about 1 billion. 2010, our manufacturing used to export excess of 1 billion, 1.3 billion, but from 2013, manufacturing exports have come down to 500,000, below 500. Now it's below 500,000. This speaks to the challenges the manufacturing is facing. When we talk about manufacturing not sitting on dilapidated equipment, manufacturing not efficient, not competitive, it's reflective of the export performance of the manufacturing. Mining sector contributes about 60% of foreign exchange in the economy, so which is roughly something in excess of $2 billion. So in terms of exports coming from manufacturing, is roughly about 2 billion. Then agriculture, the bulk of that coming from tobacco, it contributes something just over $1 billion. So these are some of the things that, from a policy perspective, you want to be able to understand, to say which are your major contributors. And whenever policies that you are proffering, they should help and address some of this conundrum. In terms of the imports, of course, we import a whole lot of variety of things, but there is a significant amount of food imports, as well as the fuel. Fuel, it means, again, speaking to what is happening on the global stage. Right now, the challenges the global tension between Iran and the US, because Iran is a major contributor to oil production, you find out that already your oil price internationally has started to respond. So it means your oil price, if it increases, it means for us being importers of oil, it means the fuel import bill is likely to rise. And if your fuel import bill rises, it puts pressure on our import bill. On the food sector, it means if we do well in agriculture, our need to import, so our import bill is roughly about 10% of total imports. So if we do well in agriculture, it means our import bill is likely to come down, and that would help us even in saving foreign currency. In terms of what's happening in the outlook, From the outlook perspective, we take cognizance of the challenges that we are having, like the rising inflation. I've spoken about the rising inflation. The foreign currency shortages, I've spoken about the foreign currency shortages. The high fiscal deficit, these are challenges or risks that we are facing as an economy. Even sometimes you could have slow investor building confidence, where investors are sitting on the fence, are not willing to commit until possibly an election. That could be a challenge. Slow pace of reforms, I've spoken about the fact that if you are faced with elections, sometimes the commitment to apply certain economic reforms that can be painful to the pocket, governments tend to delay implementation of those. So when you delay, it means you delay resolving some of the challenges in the economy. So the cumulative impact, even the rising debt, we have seen government making attempts to acquire debt from various parastatals. Again, it means government will have to pay even higher interest component on its expenditure, and that affects how it spends money. So those challenges, if they are not resolved, the cumulative impact would result in kind of weak growth in 2018 because some of the sectors would be affected by the challenges. So we hope that from government perspective, once we deal away with some of these challenges with the elections and so on, some of these things will receive attention. And hopefully, once they receive attention, we are able to arrest some of these challenges. But be that as it may, there are interesting opportunities. We take cognizance that regardless of the political outcome, a free and fair elections will position the country for economic rebound. I mean, this is what we think, because it seems like the thrust is to make sure that we change the economic course by improving, the positive sentiments that we have spoken about, how the government seeks to, institute the investor-friendly environment. The greater political will, to some extent, will go a long way in terms of addressing the sentiments. And already, sentiments is a key issue. I know one of the research institutes has already, upgraded its view on Zimbabwe on the basis of the policy intentions of government. So in terms of managing sentiments, it's quite key. But there are certain things, the friendly policy environment that we need in agriculture, the issues to do with the land tenure and supply of inputs. I think these are issues that needs attention. Your mining sector, issues to do with the access of foreign currency, is access of foreign currency for importation of raw materials is quite key. I think there are many other sectors, even your construction, infrastructure. It's because Zimbabwe has lost out quite significantly on infrastructure development. So this is an area. Why is infrastructure key? Is because when you have efficient infrastructure, even from a business perspective, the cost of doing business is significantly reduced. So you need issues to do with those infrastructure. That's why government has been talking about various deals in the infrastructure, and we are very much aware that possibly China, like in many other African countries, will play a significant role in terms of sometimes even providing the funding. We have seen them doing wonderful things even in countries like your Tanzania, your Zambia, in terms of the infrastructure. Even your developed countries, they're having to run to China in terms of structuring deals. So it's important to say, yes, sometimes there are certain things that we may not like about how some certain structures are done, but I think it's for us to define what we want and maybe be able to capitalize on our relationship with China, because I think they will play a very critical role in terms of some of these, as well as the international community. Resumption of critical industries is quite key, because some of these have very much strong linkages to the local domestic sector, and we take cognizance of the recent efforts where government is trying to clean up the issues to do with the legacy debt at Zisco. And I think Zisco, because of its strong linkages with the local economy, as well as from an export perspective, it's quite huge. New mines are coming through. I think the excitement in the lithium, where new mines have started to, setting up shop. Some of them are already in the preliminary stage to export. I think that will be very good. I've spoken about the recovery of the global economy, which is good for us because, again, it means we have strong demand for our exports. We export a lot of commodities to the outside world. If the global economy recovers, it's well and good because it means commodity prices will be high and we'll be able to enjoy those. But for us to enjoy the commodity prices, our domestic economy or our domestic policies have to speak to that. The parastatal efforts to reform your parastatals is quite key because these are growth enablers. In most cases, if your PEs are working well and efficient, it means business is able to enjoy the efficient service and reduce the cost of doing business. So we take cognizance of those efforts, and we think government is in the right path to give this attention and possibly make sure that they are speedily implemented. My few slides, maybe 2 or 3 last slides, it takes me to a Zimbabwean journey in terms of what we have experienced in terms of economic growth. So I think there are certain times buckets that you can see what I've put here to say before land reform, you can see what was happening between 1990 and about 1998. The economic growth was quite uneven. In other words, in fact, it means our economy was so fragile to the extent that you could not achieve sort of a regular, consistent economic growth. So it means somehow the economy was fragile. There are areas where you would achieve economic growth, but there are areas where we would achieve intermittent decline. So the economy was fragile. So I think we needed to acquire certain policies that would address this fragility before that. But post 1998, we embarked on a land reform. During this period, we had hyperinflation, we suffered isolation, there were serious controls in the economy, there were serious distortions. As a result, economy was in decline for 10 consecutive years. And during this period, like you say, possibly the economic value that we lost is close to about 50% of our value. So meaning to say, this lost decade is our GDP almost halved in this period. So we lost out big time. So what it means is we've lost on a critical time of our lives. And in some instances, 2006, 2007, this is the time when there was so much boom on the global economy. The commodities were at all-time high. And there's no way, when you look at the regional economies, your likes of Zambia and so on and so on, they were enjoying surpluses and growth in excess of 6% during this time. So this is where we're saying the domestic policies matter. Because if you have domestic policies that punish your local industry, you are not able to capture on this upside. So that's why we're a little bit excited to say the new thrust on the economy is coinciding with the global recovery. Meaning to say, if we are able to address some of the teething problems in our domestic problem, we are able to enjoy and capture that upside. So we are excited with that coincidence. The dollarization in 2019, in 2009, you can see there was some kind of economic stability, but the bulk of that, the economy enjoyed goodwill, double-digit growth, meaning to say, if things are to be made right, double-digit growth is a possibility. So that's what it means. Again, in some instances, it speaks to the resilience of this economy. Because during this time, I don't think we really instituted underlying structural economic changes. What we just did was to stabilize through the adoption of the dollarization, and that economic stability propelled us to achieve double-digit growth. So meaning to say, if we were to really institute economy-wide, business-friendly environment and policies, double-digit growth is a possibility. Because what it means is, over time, what it means, that goodwill began to dissipate. And because we had not instituted sound policies that would sustain the economic growth, we saw the economic growth collapsing. So that's why we are excited about this new dispensation, the 2018, 2019, 2020, where some of these can be viewed even as conservative. So what it means is, if we are now to adopt this, you can see this is a paradigm shift. This democratic dividend comes with some changes in business-friendly environment, the broader reforms that would see the increased FDI, which we have not been able to enjoy there. The international engagement that we have not been able to enjoy even during this time. So we are quite hopeful that possibly this period when the authorities pursue the right policies to address the teething problems, the optimism is there. So this is where the optimism is coming from, and that optimism is even exuberating with your external investors. So we think the possibility of turning around the economy are huge. Government still needs to do a lot of things. We have spoken about how they need to address the issues to do with the fiscal, and we think the impact may be felt beyond. We think because right now already it's focusing on elections and there are certain things that you cannot do, we think some of the efforts in terms of reining in fiscal expanding may begin to be felt in 2019. There's need to minimize the delays in the foreign exchange for businesses like your mining sector and other construction and so on and so on, accessing foreign exchange for raw materials. We think maybe over time, even a relook at some surrender requirements where businesses are having to surrender a significant portion of their foreign exchange to the Reserve Bank. In some instances, allowing business to retain some of the foreign currency may boost the confidence because at least, again, it means you are in control of some of those foreign currency. Implementation of the turnaround strategies on PEs, I've spoken about that. Governments seem to be well focused on that, and we think there's significant room for government to really expedite and implement those. Again, encouraging partnerships in agriculture and resolving some of the legacy issues would be an issue, as well as resolving the external debt. That should be the thrust. External debt and the international engagements with the international community. If we are able to implement some of these short-term and some of them long-term strategies, we think we can have a chance. My last slide speaks to our position as Zimbabwe vis-a-vis top 20 economies by economic size in Africa. So what does it say? Remember, I've spoken to say Zimbabwe, during the lost decade, we lost out almost like 50% of the economic size. So presently, what it means is Zimbabwe is roughly a $17 billion economy. So imagine if we had not lost the 50% that we've spoken about. It means we will be talking somewhere in the order of $30 billion or so. When you look at our regional counterparts that have been enjoying significant growth of above 6%, look at your Zambia, is roughly at about $26 billion. So in as much as so much has happened for Zim, I don't think we are far off from our regional counterparts. Again, to me, that is a source of optimism. It speaks to the resilience in nature in Zimbabwe. To say if we are able to put the right policies, it's possible to turn around and catch up on the regional counterparts. The largest economy in Africa is Nigeria, roughly at about $395 billion there, followed by South Africa at about $344 billion or $345 billion. Angola is quite huge as well. It's a $124 billion economy, but we are there. This, again, speaks to the living standards of the general populace, because this is your income per capita. So generally what it means is our income per capita, GDP per capita, or income per capita, it speaks to the spending power of the Zimbabweans. It's roughly about, maybe slightly about 1,000 or less. It means this is the GDP per capita. And you can see most African countries, even though some of them have enjoyed a high growth rate, but when you look at their GDP per capita, we are not way off. So it means we still have more like the spending power compared to. But ideally, you want to have your spending power to be somewhere there where your South Africa at 6,000, even your Botswana above 7,000 GDP per capita. In fact, Botswana is considered, in South Africa, they are considered like your middle income countries. I know that we've spoken about middle income countries. When you transform into a middle income country, you expect your GDP per capita to increase. So our bubble should be, when you become a more like a middle income, our bubble should begin to go up. If our economic growth begins to improve, we expect this bubble to move in this direction. And you can see some of the countries that have enjoyed quite huge growth of excess of 9%. Your Ethiopia has been able to enjoy very high growth in Africa. So there are some certain examples that we can follow from some of these examples in Africa where they've enjoyed quite high growth. So the optimism is there, and we think with the right policy environment and framework, there's a chance that Zimbabwe can do well. I think with that slide and the optimism, it's always good to end on a high note, right? So with that, I think that concludes my presentation.